Health insurance is the number one reason most people can't retire early. It is not your savings rate. It is not your stock market returns. It is this. Imagine two people. One has $1 million in the bank but is constantly stressed, checking their pulse every time a medical bill arrives. The other is already retired, living their best life because they understood the system. Most people assume they are stuck at their desk until age 65 just to keep their employer-sponsored plan. But there are 7 specific strategies that can cut your healthcare costs by thousands of dollars every single year, and most people have no idea they exist. If you are planning to retire before 65, you are in a very tricky spot. You are in the gap. You are too young for Medicare, but you're done with the corporate grind. This is where the dream of early retirement often goes to die. Private insurance on the open market can easily cost you over $1,000 per month, and much more for a family. That is $12,000 a year just to have the right to see a doctor. But here is the good news. You actually have options. You do not have to be a slave to a cubicle just for a plastic insurance card. Some of these strategies are completely legal, highly effective, and can save you tens of thousands of dollars before you ever hit the age of 65. The most powerful tool in your arsenal is the Affordable Care Act marketplace, often called the ACA or Obamacare. This is where the biggest aha moment happens for early retirees. Listen closely because this is the secret. Your premiums are based on your income, not your net worth. You could have $5 million in a brokerage account, but if your taxable income is low, the government will subsidize your health insurance. In the world of early retirement, you have total control over your income. When you are working, your boss decides your income. When you are retired, you decide. By managing your retirement account withdrawals carefully and including Social Security income when applicable, you can artificially lower your taxable income to qualify for massive subsidies. For example, a couple living on $50,000 per year in retirement might pay just a few $100s per month for a silver level plan, or in some cases, even less. This is the tactical angle that professionals use. They draw money from Roth IRAs, which is non-taxable, or they sell stocks with a high-cost basis to keep their reported income low. This allows them to live a high-quality life while appearing low income on a tax return. This is exactly how some retirees end up paying less for healthcare than the people who are still working 40 hours a week. It is about understanding the difference between your wealth and your taxable distributions. If you master this, the ACA becomes your best friend. Now, here is a strategy most people overlook because they are so focused on leaving the workforce entirely. It is called working, but not for the money. We call this barista fire. The concept is simple. You leave your high-stress career but take a low-stress part-time job specifically because they offer health insurance to part-time employees. You aren't doing it for the paycheck, you are doing it for the benefits. Think about companies like Starbucks or Costco. They are famous for offering health coverage to employees who work as little as 20 hours a week. This semi-retired lifestyle offers a middle ground. You get out of the corporate rat race, you eliminate the soul-crushing meetings, and you get flexible hours. In return, your biggest retirement expense is completely covered. You might only earn enough to cover your groceries, but if that job is also saving you $1,200 a month in premiums, that is a massive win for your portfolio. It allows your retirement savings to keep growing untouched while you enjoy a low-pressure environment and social interaction. You could work 15 to 20 hours a week and eliminate your biggest financial hurdle to freedom. Now let's talk about location, because where you live changes everything. If you are willing to be flexible, you can move to lower your healthcare costs significantly. This works on both the domestic and international level. Within the United States, some states have much more robust ACA exchanges and lower average premiums than others. Moving from a high-cost state to a more insurance-friendly state could save you $5,000 a year without even changing your lifestyle. But if you want to get radical, you look abroad. This is the international angle. Countries like Mexico, Portugal, and Costa Rica offer world-class medical care at a fraction of the price we pay in America. In many of these places, you can buy a private, high-end global insurance policy for what you would pay for a basic bronze plan in the States. Some retirees cut their healthcare costs by 70% just by moving to a beach in Portugal or a mountain town in Mexico. The quality of care is often equal to or better than what you find in major U.S. cities, especially for routine procedures and preventative care. It is not for everyone, but if you are adventurous, it is a powerful way to make your retirement funds last forever. Now, this next option is a bit controversial, and you need to pay attention to the details. They are called health sharing plans. These are not traditional insurance. Instead, they are organizations where members pool their money together to pay for each other's medical bills. The primary benefit is the cost. The monthly share is often much lower than a traditional insurance premium. For a healthy individual with a low risk tolerance for monthly costs, this can be a game changer. You must comprehend the trade-offs. As they are not regulated like insurance, they are not required to cover everything. They may not cover pre-existing conditions or limit single illness payments. A community-based strategy. It works well for healthy persons who desire protection against a vehicle accident or appendicitis. It's cheap up front, but you must read the fine print and recognize that you're leaving the regular medical system. Every year, thousands of early retirees take a calculated risk to reduce expenses. If you planned, this next tactic may be your hidden weapon. Health savings account. I consider the HSA a healthcare retirement fund. No other account offers triple tax benefits. If used for medical costs, donations, growth, and withdrawals are tax-free. If you're in your 20s, 30s, or 40s, max this out every year. Paying your medical expenditures out of pocket and investing the HSA money in the S&P 500 is prudent. You save receipts for decades. When you retire before 65, you can reimburse yourself tax-free for those previous expenses. This gives you a huge tax-free fund for premiums or operations. This is how clever retirees prepay healthcare 20 years ahead. They use the HSA as a second 401k with superior tax benefits. It's one of the best instruments for early retirees. However, I caution you strongly, this section covers what not to do. Never uninsure. I watch folks bridge the gap by striving to stay healthy. Not a retirement plan, but a risk to your life and legacy. One emergency, severe fall, or unexpected diagnosis might wipe out your retirement fund in weeks. People underestimate medical cost unpredictability, therefore most early retirement plans fail here. They assume they can pay cash for everything, but a 3-day hospital stay costs $50,000. When it comes to seniors, healthcare is one of the most significant expenses, and failing to include it in one's budget is the quickest way to go bankrupt. You have to make a plan. You need to have a strategy in place before you quit the Affordable Care Act, your part-time job, or your health savings account. Despite the excitement of independence, you should be aware of the biological risk. Retirees are differentiated from those who are required to return to work at the age of 60 by their ability to be realistic about these expenditures. It is not enough to just save money or locate a hot stock in order to obtain an early retirement. Planning for healthcare in a strategic manner is involved. In order to simplify the math, you should solve the insurance puzzle. Don't put off living till you're 65 years old. You simply need to navigate the system in a more astute manner than the majority of people. A retirement at an earlier age is more feasible and less frightening if you are able to accomplish things correctly. The ultimate cheat code to achieving financial independence is to effectively manage the costs of healthcare. The results of research and tax preparation can bring back years of life. What age do you plan to retire? Please subscribe for more information like this and comment below. Are you concerned about the expense of insurance, or do you have a plan? Starting the planning process right now could turn the idea of early retirement into becoming a reality.